something we all need, but not all of us have is, well, number one, money, and number two, knowledge about money. In today's video, I am very excited to have again on our Facebook group and on YouTube, Dr. David Keynes. You may remember him from WellPrept. He is the founder of WellPrept, and I will link in the video description the interview that I did with him regarding WellPrept. But today we're not talking about WellPrept. We're talking about finances. And this applies to not just urologists, but pretty much anyone who handles money. That means all of us. So I can't tell you how excited I am, because I did not learn about finances until I was in my mid-30s. And by then, I was way behind. This is information that I think everyone should have as young as possible, as early as possible. Thank you again for coming on, David, and sharing your knowledge.
Yeah. Hey, listen, thanks for inviting me. I have to tell you, I've been giving some version of this talk for about 15 years.
Oh, no kidding.
And as a resident, I had no idea. And my co-resident said, "Do you have a Roth IRA?" And I was like, "What is that?" And he's like, "You don't know what a Roth IRA is?" And I panicked and I started asking the attendings, and they didn't know. And so one attending put me on the path. He had me read a book by David Swenson called Unconventional Success. It was the first book that I ever read. And from that point on, I was like, wow, it's actually much more straightforward than I thought. I read about 5 or 6 more books, and, you're only 5 books away from becoming an expert at anything. So this talk is me paying it forward. And more than any talk that I ever give the residents, if they bump into me at the AUA 15 years later, they go, "Hey, that talk on personal finance, it was really great." And I'm like, "Well, what about teaching you how to take out a kidney?" No. That's, not important.
Exactly. I think of it as it's like somebody telling you, "Hey, did you know about cystoscopes?" And you're like, what's a cystoscope? What am I missing out? As a urologist.
Yeah, exactly.
So interesting today, in the power of social media. I was actually a guest on a Twitter Spaces. It's kind of like a voice platform for Twitter, kind of like Clubhouse. So I was a guest this morning. I was scrolling through my feed, and I see you post something on your Twitter feed. And it was a picture of you giving a presentation about financial wellness. And then I reached out to you, and I said, "Hey, would you mind giving this talk?" Believe it or not, I heard some version of this talk already at the end of 2020 at the Young Urologists presentation at the AUA annual meeting. And I thought that was fantastic. And so I reached out to you, and you said, "Hey, how about this afternoon?" I'm like, I'm all in, because this is something that all of us should definitely know, but not all of us do. And it is so absolutely important. And for those of you who are watching this live on Facebook and or YouTube, feel free to leave any questions in the comments, and I will definitely pass that along to Dr. Keynes.
All right. So this is the talk that I wish I had gotten when I was a medical student or a resident. So let's get into it. So this is me. I'm an associate professor. I work at Leahy. And as far as disclosures, most of the stocks I own are index funds. I do have a small position in Doximity, very small position. And as John mentioned, I'm the founder of WellPrept. But more important disclosures are that I am not a financial advisor. I never even took econ as an undergraduate. As I mentioned, everything I learned from books. But if you're listening to this and you're a medical student or a trainee or young staff, that you should feel empowered by hearing that. You should think to yourself, "Oh my God, I could learn all this stuff by reading a few books, and I can send along a reading list after this as well." And this is an intimidating topic to many, and it's well known that it's made intimidating on purpose, because there's a whole industry that profits from your thinking that it's complicated. And that people make oodles of money off of you thinking that. And so it's actually pretty simple, not that complicated. And you should be aware that the industry considers you a whale. So financial professionals and wealth managers see a doctor and they think you're a whale. A whale is a very slow moving, bountiful target that if you harpoon a whale, you get a whole lot you reap the benefits and they're easy targets. So you don't want to be a whale. And if you only need to know a little bit in order to avoid becoming a whale. And what I tell people is if you can analyze a 24-hour urine, you can do this. And the thought bubble that pops up in most people's head is, well, I can't analyze a 24-hour urine except the night before the in-service exam or whatever. But, I'm just pointing out it's pretty straightforward. So what I'm going to start off with is going through some terminology. And with every term that I go over, I want you to think, wow, that sounds complicated, but it's actually pretty easy. It's a recurring theme. So capital markets are just where investors buy stocks and bonds. A security is just a blanket term for the product that you've invested in. So either a stock or a bond or something else. That's broadly called a security. An asset is anything that has value. And we'll talk about the importance of asset allocation, which only means how you divide up the pie into asset classes. And what are examples of asset classes? Those are just categories of investments, things like stocks, bonds, cash, real estate, precious metals, commodities. And we'll review these, but they're just categories. That's it. Your net worth is your assets minus your liabilities. And there's versions of this like liquid net worth or investable net worth. But basically, as a resident or young staff, you typically have a negative net worth. What you owe is bigger than what you own. And I can remember the day clearly where I used Mint as an online budgeting tool, and my net worth finally crossed zero. And it was a number of years into practice before that happened. But it's broadly important to be aware of that. Now, instead of just saying stocks and bonds, the industry does this thing and they do synonyms and they say equity and fixed income, which I swear is just another way of making it sound complicated. They'll talk about what's your equity exposure, which is just saying what percent of your portfolio is in stocks. That's it. And instead of saying bonds, they say fixed income, and we'll talk about that in a minute. And a stock, all it is a share of ownership in a corporation. And the returns are supposed to be based on how investors as a whole assess the future profit of that company in present value. And those are traded on a stock exchange, which can be electronic in some cases, or it can be a physical place. This building in this picture is the New York Stock Exchange. And this slide here is just so that you have heard these terms. These are different ways of evaluating stocks. And when I was in high school, my father would open up the newspaper and actually look at all the stock tickers and the stock charts, looking at things like earnings per share, PE ratio. You can look into financial press, research, reports, SEC filings. The punchline of this talk, as you'll see, is you probably don't need to do all those things. But the one thing in this list that's worth knowing is something called the PE ratio. And the analogy I like to tell people is if I showed my 5-year-old a nickel and a dime and asked him which one he wants, he would ask for the nickel because it looks bigger. And that's a mistake. So similarly, a stock that costs $100 might not be worth more than a stock that costs $10. It all depends on the ratio between the stock price and the earnings. And if you do compare PE ratios, you can compare apples to apples. This is an old reference to James Bond. A bond is a loan you make in return for the promise of being paid interest. Now, the fact that you are being paid interest is why it's called fixed income. So whoever's issuing the bond promises to repay the principal, the total amount, at a certain date, which is called maturity. Again, it's designed to sound complicated, but you could buy a 5-year bond. So at 5 years, they promise to give you back what you invested, and they pay interest along the way. And it could be from corporations, corporate bonds, governments, local municipalities, municipal bonds. And these are fundamentally different from stocks, where stocks are not obligated to pay you a thing, not a penny. The value can go to zero tomorrow, whereas there is a contractual obligation with bonds. Now, people can default on the bonds. There's some that's called credit risk, but that's why we put them in these huge different categories, because they're so different from each other. And that's why they call it fixed income, because they pay you interest on a regular basis. Now, just a little tidbit, a money market fund is actually considered a very, very short-term IOU issued by the government. You'll see it on, if you belong to like a 401k or a 403b, they'll have money market funds. That's what that is. Now, this is a truism that's important to know. If interest rates go up, the value of bonds go down, because the bond, whatever percent the bond pays out is less in relation to the price of things in the world. So we're in a rising interest rate environment, and the value of bonds can go down. So there's this rule of thumb to keep bond maturities short and less susceptible to the ravages of inflation. In practice, as you'll see, we tend to just buy bond index funds, or that's one strategy where you don't really have to think about this thing, but it's good to know. Now, bonds are rated. So at the, AAA all the way at the top, very credit-worthy bonds like those issued by the U.S. government, and then all the way on the downside here, D-rated junk bonds. So here's another example of a simple concept made to sound complicated. Junk bonds are riskier. They might pay higher interest, but there's a chance of default. All right, now, this next slide is designed to demystify different ways of categorizing stocks, just like we categorize pharmaceuticals, cardiovascular drugs, antibiotics. We can categorize stock types. So starting from the left and moving to the right, we can do it based on how big the company is, and that's called market cap. Big companies, medium-sized companies, small companies. Or we can do it by sector, we could say. Pharmaceutical companies, electrical companies, technology companies. We could do it by geography. Companies in the United States versus companies elsewhere in the world. We could do it by value versus growth. Stocks in the growth phase are like Google in the late 90s. Stocks that are value are more established, but maybe worth more than the market is valuing it at a given time. We can do it by ownership risk, so emerging new companies versus well-established companies. The reason to know this just broadly is if you look at a list of mutual funds, they all use these terms, and they might have investment objectives like we invest in utility companies and or socially responsible fund. And again, it's a complicated thing or an easy thing made to sound complicated. You'll also see this thing called a style box. And all it is a 3x3 grid that I mostly ignore, but it's basically telling you, if you look at a fund, what most of the holdings fall under. So on the left, we have big, medium, and small companies that are either value companies, growth companies, or somewhere in the middle that they call blend. Again, this is not a very practical thing. Like I don't go searching for things in the upper right-hand corner, but you'll see it if you look up anything online in Morningstar. So it's good to know what it is. Next important concept, what's a mutual fund? Mutual funds pool money from investors, and somebody or a group of people are in charge of managing that money. And it's a way to diversify in a single purchase. And each fund has an objective. So, for example, you might have a foreign growth fund or a socially responsible fund that doesn't invest in tobacco and firearms. Or, the possibilities are limitless. And if you go back to that chart I showed you a few seconds ago, mutual funds have certain strategies, and they all charge a fee. They only are traded at the end of the day, one time, as opposed to something called an ETF. And again, this is made to sound complicated. An ETF is just a mutual fund that trades throughout the day, just like stocks. That's all it is. So what we've just gone through is nomenclature and things like that. Now I'm going to move on to the next point, which is a key point, and that is something called an index. Now, imagine that I could create something called the Urology Surgery Index. And every day, the computers would tally up the number of vasectomies, most of them done by John Lynn, and the number of radical prostatectomies in the country, the number of UDS studies, the number of urine dips, and it would tally it all up and give some point system. And we would listen to NPR, and it would say the urology surgical index is trailing it's dropped today. The surgery numbers are down. We attribute it to COVID. And then, next month it's going up. People are seeking urology care and getting operated on. If we could create some kind of urology surgery index, similarly, there are indexes that tell you how the market is doing. That's it. And it's very important. So an index is just a benchmark, and it reports the up or down changes. Some of them use points, some use percentages in some part of the market. Now, examples: the Dow Jones Industrial Average, the NASDAQ, the S&P 500, the Nikkei, the FTSE, the Wilshire. You hear these on the radio or on CNN, and it sounds very, complicated. It's not. You need to know that this is just a quick way of telling you how the market is doing today or over some period of time. So I took this screenshot from my phone in May. And on this day, these three very famous indices, the Dow Jones, the S&P 500, and the NASDAQ, all dropped by significant percentages in one day. And I'll tell you what those are. So let's go one by one, because these are the most quoted indices in the world. The Dow Jones Industrial Average, it gives a general picture of how the market is doing. Now, amazingly, this is only 30 companies that comprise the Dow. And they're called blue chip companies, which is a poker reference. If you play poker, apparently the blue chips are worth a lot of money. But these are some of the most, biggest companies that do the best in the world. You may notice a lot of these logos. GE is a famous dropout. So what happens is, it's always 30 companies, and if one starts to lag, they boot them out of the index, and then a new up-and-coming darling company that's doing well gets added. You could see by knowing how these companies are doing, Walmart, Bank of America, Procter & Gamble, Cisco, that's a general feel of how the economy is going. And then this is a different look at it, the S&P 500, and you guessed it, 500 large companies comprise this index. And if you look at those logos, you recognize a lot of them. And Sears, Lehman Brothers, and Dell are famous companies that started to do terribly and got booted out of the index. And then they got replaced by three more. This is weighted for the size of the company. And so it's 500 large companies. And it's usually used as a standard of comparison. Like, how did this mutual fund do compared to the S&P 500? Did it lag or did it beat it? The NASDAQ composite index is made of 3,000 companies, and most of them are technology stocks. Not all of them, but most of them. And if this is kind of like Trivial Pursuit type knowledge, but if a stock ticker has 4 letters, that means it's on the NASDAQ. That's kind of a smarty pants, stocks nerd fact. So if you use these indexes, they're a benchmark for market return. Now, you have to be sure to compare apples to apples. So for example, let's say I owned a small cap mutual fund. And now at this point in the talk, that just means a bunch of small companies in one fund. I can't compare how that did to the S&P 500 because I already told you that that's an index of how large companies in the US did. Lo and behold, there are indexes for small companies. They're called the S&P 600 or the Russell 3000. Suffice it to say, you have to compare something to the appropriate benchmark. All right. So we've talked about nomenclature. We talked about indexes and why they're so important. Now we're going to talk about commodities. And commodities are just the raw materials used to make other things. And my dark humor is that I put a picture of a doctor in there. These days, we often feel like commodities. And, I'm joking, half not joking. But we have things like corn and crude oil, wheat, grains. some people think you should have a tiny bit of exposure to commodities in your portfolio because it might zig while other parts of the market zag. But it's important just to know what they are. Inflation, very hot topic today. It's a persistent increase in prices. And it's why keeping money in a checking account or a savings account is losing value over time. But if it's not keeping up with inflation, it's worth less and less. And just to get nostalgic for a second, in 1959, you could buy a house for $11,000. Average annual income was $5,000. Postage stamps were 4 cents. Gas was a quarter. Unbelievable. So now, historical annual U.S. inflation, this is from the 1950s to the 2010s. We had huge inflation in the 80s. It hovers around 2 to 3%. If I continue this graph to the right, we're back up around 8% now, which is scary. We can all see it in the supermarket and at the gas pump. All right, so now you know about inflation. Now, this is one of my favorite parts of the talk, and I entitled this part, "I can't make you money, but I can save you hundreds of thousands of dollars." And that's absolutely true. And you may be wondering, how the hell is Dave going to save me hundreds of thousands of dollars? This quote, "Compound interest is the eighth wonder of the world," is attributed to Einstein. Although I have to say, I can't find any evidence that he actually said this, but we're gonna go with it as if it is an Einstein quote. But compound interest is where interest earns interest. And it's a very powerful thing when you can leave money invested for a long time. And it's as opposed to simple interest, where you have the principal and a certain percentage just gets added each year, but not of the whole. So the interest doesn't earn interest. It's the blue line in this graph. And if you look at your retirement portfolio over 30 to 40 years, it will look like this. And the important thing to understand is it's very boring early on and it's very exciting later on. But if you, in the first 10, 15, sometimes more years of your career, as long as you're invested properly, it may still seem like barely anything's happening as you check your accounts, and you can't get frustrated and be like, well, to hell with it. The real magic happens very late, and between age 60, 65, 70, if you've been at it for long enough, that's when things really start to accelerate. And no matter who gives this talk, there's always an example like this. So I just want to give a quick example to hammer home the point of investing early, okay? So just quickly, we have Dawn on the left and Dave on the right. Dave is a procrastinator. Dawn is what we aspire to be. She starts saving at age 25. She invests $20,000 for 10 years. That left-sided thing is her investment. And that grows to $314,000. Dave waits 10 years till age 35. He saves 3 times as much over 3 times the period of time, $60,000 for 30 years, and ends up with much less. So if you're young and you're looking at this, you should think, oh my God, I have to start early. But as a trainee, you may say, well, I mean, what's the point? I don't have enough left over to save. So here's an example. If you saved $100 per month during residency for 5 years and then let it be for 40 years, and the market did well, 9%. And by the way, that's no guarantee. That ends up being $188,000, which is, might buy you a gallon of milk at that point. No, I'm just kidding. No, that's nothing to sneeze at. So even small amounts are worthwhile. Now, this is where I talk about fees and prove to you that I can save you hundreds of thousands of dollars. So if you're going to pay attention to any part of this talk, this is the time. If an investment advisor comes to you and says, I'll manage your money for 1% fee, ask yourself right now before I reveal the rest of the talk, is that cheap or is that a pretty good deal? A pretty good deal, or is it a terrible deal? I'll show you. Let's give an example. So you invest $15,000 a year and you increase that amount by 2% per year. That $15,000 is what the IRS limit was for a 403 in 2008. 6 or 7 when I came up with this example, but and now it's 20,500 or so. So the total gets increased every year. You do it for 35 years and the market returns 7.5%. If you could do that for no fee, which is really nearly impossible, your nest egg would be 3 million. I'm not saying this is what you should do. Hopefully you end up with more than that. I'm not making a value judgment on that. I'm just using this as an example. Now, if you had to pay 0.25% fee, and this could be to an advisor or the fund charges this, it doesn't matter. You forego $173,000 and your nest egg is down to 2.9 million. That 173 is not all fees. Some of it is the fact that the fee is not sitting there and compounding for you. Nevertheless, that's the amount that your nest egg is decreased. If it's 0.5% fee, you're now down $335,000. 0.75 or 0.75%, that's also called 75 basis points, by the way. It's $500,000 that you're giving up. And for that 1% fee, you're down $630,000, which is far more than, which is about 87% of all that you invested total. Now, think about this for a second, okay? That 1% fee, imagine that same advisor came to you now and said, I'll manage your money for $630,000. You'd be like, no way. There's no way I'll do that. This should be a jaw-dropping moment for you. I mean, it's crazy. And the investment universe of money managers, they know this. This is why they have second houses and boats and yachts and things like that. So you should remember 1% is a lot. And there's this cartoon that I like, which says, I think I can explain what happened to your investment with the use of this simple chart. Fool and their money are parted. So I would encourage you to understand here, 1% fee is a lot. It's impossible to invest at 0%, but you should try to keep your fees certainly under 0.3, if not under 0.2. All right, so now we're moving on to discussing another favorite topic, which is active versus passive investing. Now, how many of you at your residency interview wore a name tag which said this, I'm average? Nobody, because you're all overachievers, great students, and that is a trap when it comes to investing, because you're so special that you think you're entitled to super special investing vehicles, which most of the time are going to be a trap. And I'm not saying they'll never work out, but for all intents and purposes, I would shy away from them. Now, there's two camps. One is active investing and the other is passive investing. Active investing is an attempt to beat the market. You can only do that by picking stocks better than everyone else or by timing the market. Passive investing is called indexing. I have a picture of a couch potato here. The management of a S&P 500 index fund is just trying to buy exactly those 500 companies in the same proportion as the S&P. That's it. And which is better is a never-ending debate. The question is, can the market be beaten consistently? The answer is yes, but it's rare. So I'm going to just try and prove that to you over the next 5 minutes. This guy is Jack Bogle, and he passed away just a couple of years ago in 2019. And he was the founder of Vanguard. And he was an index fund pioneer. Now, you have to remember, in 1975, when he came up with this idea that he's going to create a way for investors to be average, it seemed like a ridiculous idea, and he was ridiculed to a great degree for this. And now it's, widely accepted as one of the best possible strategies. But it was not the case in 1975. Now Vanguard is laughing all the way to the bank with almost $5 trillion in assets. And fun fact, he was a heart transplant recipient. Now, here are the emotions of the active investor. the person who's trying to beat the market. Let's start off on the left. So the market's low, you're feeling uncertain. It starts to climb. Interest, confidence, greed. You have a desire to buy. Of course, you're buying at the peak, which is the opposite of what you should do. Market starts to fall. You have doubt. It falls further. You want to sell. You're selling low, which is also the opposite of what you should be doing. Then you're dominated by fear. The market rebounds. You missed the rebound and you regret it. Whereas the emotions of a passive investor is you buy no matter what happens, and you're relaxed the whole time because you know that you are at least going to capture market returns. So the punchline is you should aim to be average when it comes to investing. And certainly there may be some exceptions, and congratulations to you if you're listening and you have wildly beat the market, but most people are not going to be able to do that. And in this conversation, everyone likes to bring up Warren Buffett as the example of somebody who can beat the market, and it is true, but the chances that you find a Warren Buffett for the 35, 40 years of your career to give your money to is almost impossible. This is adapted from a Wall Street Journal article in 2016, and I love this to hammer the point home. These are all active funds, and the question is, what percent of them do worse than the index over 5, 10, and 15 years for large, middle, and small company mutual funds? Look how high those numbers are. Over long periods, more than 90% of funds lag the index that they should be compared to. So you may look at this and say, well, there are some funds that beat the index. Yeah, there are, but you're not going to find them. So just by being average, you're going to win. Now, the story gets even better when we look at the average fees for active funds is 0.77%. The average fee for passive funds is 0.1. Now you know that you're an expert and you know that 0.77 is ridiculously expensive and you're paying more for poor performance. And so you look at this and you think it's no wonder that the investing professionals don't want you to know this. And so that's why I love paying this forward and just giving you this little piece of information to protect you in your investing career. Now, what if a fund does really well in 1 year? Does it repeat in the next year and the year after and the year after? The answer is no. So this study gets repeated every year with the same results. But the funds in the top quartile in 2014, the percent that stay there in subsequent years is nearly none of them. So luck has a lot to do with success, and it's usually not repeated. But if we ask somebody who actually knows what they're talking about, not David Keynes, but Warren Buffett, he's been quoted as saying, the best way to own common stock is through an index fund.
Sounds like you're muted again. There we go.
Oh, okay. So is it really that easy? It really is that easy. That's the beauty of this topic. Once you learn more about it, you realize how simple it is. So we talked about index funds. We talked about low fees. Now I'm going to talk a little bit about time horizon and risk tolerance. The point is, you can't get something for nothing. I can't, Bitcoin has come in to the fold. I can't predict what the next hot thing is going to be 15 years from now. But I can tell you, if someone approaches you with a high risk high return, low risk proposition, you should run in the opposite direction. There is no such thing as high return, low risk, not for any long period anyway. And this is an academic curve called the efficient frontier, which basically proves that. I don't want to bore you with it too much, but the 100% bond portfolio in green is the safest, and the returns on the y-axis are going to be the lowest. 100% stock portfolio is going to have higher expected returns, around 8 or 9%, but with the highest volatility, the standard deviation being high on the x-axis. You can't really deviate from this curve in terms of risk and return. So I hope that's clear. Now, The next thing you need to know to have inner peace is you have to understand the history of how markets behave. All right. The S&P 500 historically returns 10%, but that's years with huge gains and years with huge losses. We're in the midst of a year with losses. But if you've seen this movie before, then you don't get too upset by it. And for those of you who are just entering your career, you haven't seen this happen. So that's why you need to learn about what these cycles are all about. So here's a graph of total returns between 1926 and 2011. Look at all those blue bars. Each one of those is another year in the positive. And look at all those negative years. On average, every third year or so is a losing year. That's just how this thing works. And so this year, I just took a screenshot from my phone the other day. On September 1st, 2022, I looked at the last year. We're down 12.5%. This is just a losing year. It's part of the deal. Now, if you have a long time horizon, you can celebrate because stocks have gone on sale to what they were in March of 2021, which is good for you. You get to, I mean, listen, we all prefer that the market not tank, but the upside is you get to go back and keep buying things for what they used to be a couple of years ago. If you zoom out even further and you look at 10, 15 years or all the way back to 1984, we can see that every time I draw an arrow here, there's a giant crash. All right. This is just part of what happens, and it's happening now. Now, I drew that blue line up and to the right, and you can screenshot this and then come to me in 10 years and tell me if I was right or wrong. This is not a guarantee, but there's a lot of reasons why the stock market should be expected to keep going up over long periods. And I'll just name a few reasons. One is innovation. Companies like Tesla now exist. They didn't exist 20 years ago. All the money is going to flow there. They become the new company in the S&P 500 and continue to innovate. At a certain point, that'll die, and there'll be a new innovation of the company that helps us do teleportation or whatever it is. So, and then existing companies become more efficient and they earn more money, and the cycle continues. Now, you can have long periods of stagnation where this doesn't hold true, and so that's why it's not a guarantee. But there are reasons to expect the stock market to continue to go up. But over short periods of time, so this is the range of returns in the stock market over 1, 5, 10, 15, 20, 25 years. Over long periods, there's a tighter standard deviation. Over short periods, like 1 year, you can have massive gains or massive losses. So the stock market is not a place for money that you need within 3 years. That's what you should conclude from this. It's for a longer time horizon. Now, what happens when there is a decline, big decline? How big is it usually, and for how long? This is backwards looking, but in the past, usually they're down by about 29% and take at least 9 months to recover. That's just the history of things. All right. Take a deep breath. We're in the home stretch. We're going to talk about market timing. Market timing means when there's a peak, I'm going to sell. And when there's a crash, I'll be out and I'll buy at the bottom when things are cheap. That's called market timing. Does it work? The answer is no, it doesn't work. And this is another one of my just absolute favorite slides. It turns out that over a 20-year stretch, there are 5,040 trading days in 20 years, okay? So this next slide looks at it as an example of what happens if you were invested over the full 5,000 days without taking your money out. That's the bar on the left. Your returns were 9.2%. The next bar, 5.5%. If you missed only the 10 best days in those 5,000 days, 5,000, your returns are nearly cut in half. If you missed the best 20 days in that 20-year period, your returns are 3%, barely match inflation. If you miss the best 30 days, forget it, you're flat. And any more than that, your returns are negative. This is a potentially life-changing slide. Anytime you think, oh, but this time it's different. And in fact, in some of the recent elections, I called my father on the phone, who also taught me a lot of this stuff. And I said, Dad, I know I give this finance talk and everything, but I think this time might be different. I think I should go out to cash. And then I stay the course, and I remember this slide. And really, even the smart talking heads on CNBC don't know what's going to happen next. So really nobody does. You have to stay invested, period. And anytime you think you get smart and you're going to pull out to cash, don't do it. So the key point is that the market moves in fits. Miss a few days, you miss out on all the gains. So now I'm going to talk in the next stretch about how to build a portfolio in a basic way. Now, one of the most disturbing conversations that I have over and over again with residents and young staff is, I say, are you invested in your retirement account? And they say, yeah. And I say, well, in what? And they say, in the 401k. I say, I know, but what is inside of it? Oh, it's in the 401k. I don't know. Well, what is it in? Well, I don't know, but my balance is going up, so it must be fine. That is like almost makes me want to cry every time that happens. So listen, the name of the account, 401k, 403b, Roth, 529, that's just the type of account. Inside of each of those is a menu of investment options that you have to actually pick something. And if you don't pick something, you'll be defaulted into something. And lest you think that the people choosing to default you have your best interest at heart, they may be defaulting you into something very expensive that's actively managed. I see it all the time. So you need to go and look and choose. So this next part is how to actually do that. And the asset allocation is the biggest decision that you'll make. That's how to divide the pieces of the pie. All right. The biggest decision is stocks versus bonds. Okay. And you should spend the most time on that question. And that has to do with your risk tolerance. So, and I can't tell you what yours should be. So some people are very conservative and other people are really aggressive. And you can go on Google and type in risk tolerance calculator, and you'll find something like this. I'm not saying you should use this specifically. I'm just trying to get you a flavor, but you answer the following sentence. I can tolerate losing blank percent of my portfolio in a given year, and therefore my stock percentage should be blank. So if I'm young, 30 years old, let's say, I have a long time horizon, and I truly understand that the market may dip 35% this year, and I'm okay with it, truly okay with it, then you might do a 90-10 stock bond split. And if you're not okay with seeing those huge dips, then you need to drop your stock allocation appropriately. All right. And so this is an exercise that is well worth your time. Now, excuse me. Let's just say hypothetically that you've done that soul searching and you're a 60-40 type of person. Now, we're going to do 60% stocks and 40% bonds. In those sections, stocks, we can decide US or foreign, large company, medium size, small company, value, growth, and it starts to be intimidating. On the bond side, government, corporate, short-term, long-term, and you start thinking, maybe I do need to hire a professional. But what if there was something called an index fund of all bonds and an index fund of all stocks? That would make life easier. As it turns out, there is. I'm just giving you this as an example. There's something called the Vanguard Total Bond Market Index Fund and the Vanguard Total Stock Market Index Fund. You could choose that and you would be done. So it's that simple. Now, you could decide to be fancier and you could split up that stock side and add foreign stocks. And there's actually something called the entire market except for the United States fund. And you could add real estate. You could get even fancier and split this stock side up. But what I'm telling you is it's all going to end up being about the same returns as just this. So you can make it as complicated as you want. My advice to you is to keep it simple. One thing to keep in mind is you have to do something called rebalancing. So let's say your DNA makes you a 50-50 person. The market does its thing. Now you're 62-38. You need to rebalance, buy some of the winners and sell some of the losers in order to get back to 50-50. Otherwise, if the stock does its thing, you're not okay with the 62-38 based on your constitution. So some funds will do this automatically, and those are called target date funds. And I just want to mention, sometimes these are fantastic and sometimes they are horrible. And why am I all over the map? Because it depends on which company is making them. They're all strikingly different. And they have this thing called a glide path, where depending on how many years you have until retirement, they'll have less and less stock over time. This blue spread is the spread between all the major brokerage houses on how they handle the allocation over time. Look at that. At 15 years, there's a 40% spread between, say, how Vanguard sees this versus Schwab versus Fidelity versus TIAA, CREF. And some of them use index funds to build them. Some use active funds. So know what you're choosing. And my advice is make sure it's index-based and that you agree with the allocation. Otherwise, you could pick a different year. If you're going to retire in 2040, you could pick a 2030 or a 2060 fund if your risk tolerance is different. All right, so we're almost at the end, and I just want to give one more example to hammer home the point about fees. Let's say you invested $20,500 per year for 30 years at 8%. The difference between paying 0.14% and 0.65% is almost $500,000, all said and done. So again, just remember, low fees. Now, this is sort of like a lightning round. I'm just going to go through some quick rules of thumb. And in the end, the conclusion is ignore all rules of thumb. On investing, create a plan and stick with it. Don't assume you need professional help. If you do, get something called a fee-only advisor, which you pay by the hour instead of a % of assets. You want to be the market. You want to ignore hot stock tips, rebalance every year, make it automatic, pay yourself first. Keep your fees low, be boring. You're not trying to get rich. You're trying to outpace inflation. On personal finance, save at least 10% of your gross income, more if possible. Pay off high interest debt first. You should have a life fund. Just yesterday, a giant tree branch fell into my backyard and I have to pay to get it cleaned up. That's not really an emergency. It's just life. You need to be prepared for it. You should prioritize retirement over 529 plans. A sobering calculation is that you need to invest $5,000 per child per year from birth if your goal is to fund private school education because of how fast tuition is rising. Most doctors will end up getting term insurance about 6 to 10 times annual salary and not whole life insurance. Don't touch your retirement savings if you can avoid it. More suggestions. There's some great online savings accounts. If you get reimbursed for a work trip, try to save it. You've already absorbed the cost. Ignore water cooler banter. This is a small thing, but I like using Acorns because it rounds up to the nearest dollar and you can save a little bit of money on the side. Spend no more than 2 to 3 times your salary on a house. Ignore all rules of thumb. The last thing I really like to mention is to enjoy life. You never know what health concerns are going to hit you, and you can't wait and defer all enjoyment in life until retirement. Your family and your loved ones deserve to to have enjoyment while you are working. And so I'm a big fan of spending on vacations and experiences, but that's on my own personal bias. A checklist for now: get your own disability insurance policy, update your beneficiaries, get even a basic will using LegalZoom. You could always make it more complicated later. Review your retirement investment choices, start a Roth IRA. I can email a reading list. White Coat Investor is great. So to summarize: low fees, index investing, stay invested, maximize your contributions, insure yourself properly, remember history, and enjoy life. If you can conclude that nobody can consistently beat the market or time the market, then it's not worth hefty fees for the illusion that either one would happen. And our closing slide is just to hammer the point home that I am also human. I have tried to do everything that I've spoken to you about and not always succeeded. This is like Instagram versus reality. This is the Instagram picture of my kids, and the reality, they're complaining, Dad, stop taking pictures, blah, 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 you know. So personal finance is often exactly like that. That is a wrap.
Wow, that was amazing. So much awesome information. I like how you started. I haven't seen this presentation. I like how you started with just the basic terms and dumb it down for pretty much everybody, and then went on to talk about the more global concepts. And I wrote some down, like compound interest, which a lot of people don't understand. Compound interest versus simple interest. Compound interest is the initial money that you put in makes money, and that extra money that your initial money made is making you more money. So that is eighth wonder of the world, which I did not learn about until I was in my mid-30s. I was like everybody else, had a credit card that I got while walking on Bruin Walk at UCLA. Hey, would you like to sign up for a credit card? Immediately, I went into debt. So I made the same mistakes like everyone else did. I think what saved me was we grew up poor, so I realized, oh, that's not a good thing. So I got out of that real quick. And then the fees, the investment advisor fees, is very, very important. Like you said, over time, that compound interest, whatever amount that they take off of your ability, the fees that they charge is deducted from the amount that they have, that they manage on your behalf. So assets under management, they take a percentage. And if it is a 75 basis points or 100 basis point or 0.75% versus 1%, that's a significant amount of money. That's a big, big chunk of money. I'm not saying that all advisors are bad, nor am I saying that you don't need an advisor. Some more complicated setups that you have, you may need an advisor. So the main thing is finding a fee-only advisor, and that is not as easy as you think, believe it or not.
No, it's not.
Fee-only advisors are hard to find.
Yeah, I mean, I think if you decide to have an advisor, number one, at least understand that you're paying a lot of money. Don't be somebody who agrees to a 1% fee and is shocked to find out how much that really is over time. And you know, there are personal dynamics where sometimes in a family, a husband, wife need a third party advising where it doesn't come from within, where the information may be less trusted. But at least know why you think you need it, that you definitely can't go it alone. And some people really are okay with paying that much, but very few, once they really understand how much it costs over time.
Yeah, I agree. And the other thing is something else you mentioned, risk tolerance when you are investing. People need to understand how much risk, and the question you asked was perfect. How much risk am I willing to take? Or better yet, what is the amount of money or what percentage of my investment am I okay losing in my investment? That's right. In the total amount that I've invested. And that determines your risk tolerance. And you should not invest in anything that you're not willing to lose. On the other hand, if you are investing in some sort of an index fund like an S&P 500, chances of the S&P 500 going down to something permanently zero is so unlikely. And if that were to happen, you have better things, you have more important things to worry about than the balance in your stock portfolio.
I agree.
That is my perspective.
Let's pull on that thread a little bit more. Let's just make it really concrete. The last year, the market drops 13%. If you're in your 30s or 40s and that freaks you out, either you haven't learned enough yet, okay, or your asset allocation is wrong based on your risk tolerance. Same goes if you're in your 50s and 60s and 70s. If you are freaked out by the fact that the market dropped this much, then either you need to learn a little bit more about how markets work or adjust your risk tolerance and your equity bond split. So when I see people overreact, it's either one or the other.
Yeah, that's so funny because my Vanguard account is down at least, well, exactly 13.4%.
Yeah. Yeah. And I mean, don't get me wrong. I'm not like totally happy about it. I don't like seeing my Vanguard account drop by, even though it's unrealized losses. It's painful. It's painful. Don't get me wrong. I mean, it's not like I'm complete zen about it, but at least I'm not panicking. I understand that I don't need that for a long time. And in the end, it'll look like a blip on a larger graph. We're all human. It's painful to look at.
Yeah. But you also look back at how it has done the last couple of years and you realize, wow, what a bubble that was. And now this is a small correction. But if you look at the overall trend of the S&P 500, it's up year over year. If you look at the overall trend, not just a small time period, look at the overall trend, it's up. So you like you said, when you leave your money in the bank, the ability of the money to buy something, that same thing, decreases, and that is called inflation. The key with these funds, index funds and investments, is to make sure that your money is not losing value. You're not losing the value of the money due to inflation, meaning today's dollar, hopefully you'll have $1.10 in 5 years or 2 years instead of having 90 cents when it comes to purchase value.
Right, exactly. You know what I find so interesting, John, is that doctors are so good at recognizing trends in their patients, like the creatinine trend and you operate on somebody and the crit drops and you don't panic. You're like, that's just dilution. I've seen this before. They're not bleeding. But when it comes to the stock market, they're like freak out, and the only difference is learning a little bit. You don't have to even learn that much, just a little bit of knowledge to get past the irrationality.
And let's see, maybe you can send me a list of the books like Bogle Heads or White Coat Investor, very fundamental, very easy books to read. And once you understand the basic concepts, I think of it as coding and billing. Once you really understand the vocabulary, it makes sense and it's not so intimidating anymore. And you can just okay, well, that's the market took a dump, big deal. It'll recover in the long run. I think a lot of it is just learning the terminology, learning the concepts. And then once you understand the concepts, you don't freak out. Instead, I think of what's happening now as a buying opportunity. So like what you probably have already done, you probably have dollar cost averaging. Every single month, you're automatically putting some money into some index fund. You don't even think about it. It's done automatically for you. A certain time of the month, you put in a certain amount that is done automatically out of your savings account.
Yeah, exactly.
Recently, I actually invested more because everybody thinks, the market is down. I'm going to get out of the market. I think of this as a buying opportunity. So
that's exactly how it should be thought of. It's like everything went on sale. Yeah, no question about it.
So anyway, I certainly invested more in index funds, believe it or not. More in index funds. And it's rare that I try to pick individual stocks because it is much more risky, but it's fun.
It's fun, yeah, and I think I'm glad you bring that up because I think it's okay for people to do it as long as it's a small percentage of their overall portfolio,
That's how I feel about crypto too.
yeah, me too. I think now somebody once gave me some good advice about Bitcoin. They said, whatever the latest fad investment, consider the concept of intrinsic value. Intrinsic value is, like, for example, stocks pay a dividend or they have the potential to. Bonds pay interest. Real estate pays rental income. These are real assets with intrinsic value. And so Bitcoin comes along and you say, well, like, it's a digital currency. Does it have any intrinsic value, or is it just worth what the next person is willing to pay for it? I don't want to get into a Bitcoin debate, but it probably doesn't have intrinsic value. I'm sure there's people out there who are like screaming and yelling.
No, I totally agree with you. It is, the intrinsic value is whatever the value the next sucker is willing to pay. And the delta is how much you make. Really, there's really no, it's whatever the market is going to say, that's how much it is. So yeah,
and I think if you use the concept of intrinsic value and risk return, those two barometers can let you evaluate whether some new investment that you and I haven't thought of yet is worth anything.
Well, I think for most physicians, most urologists, 4 years of med school, 5 or 6 years of residency, you took 9 to 10 years to get to where you are. I think hopefully some of us will understand patience. And you've waited this long. Hopefully you understand patience is what is also needed in investments. Long-term, you think long-term and not quick return unless you are in a bind and you need some cash, and you hopefully you're not taking too much of a risk. But over the long term, I think it's pretty safe to invest in the way that you described, in a balanced way, watching for fees that you pay in whatever mutual funds or index funds, and consider getting some fee-only advice from a professional.
Yeah. Since you mentioned patience, I just want to make one plug for the white coat investor, Jim Dolly. I have no financial incentive to plug him. I just think what he does is really great. He talks about being patient and not buying the big house and the fancy car, and deferring some gratification right after residency until you get your financial footing. And I think that there really is something to that. We've been held down less than minimum wage on a resident salary for a long time, and there's a tendency to just explode after that, and that's to be resisted. I think that's another aspect of patience that he's really good at articulating.
And I think if you read many of my posts, I've said in the Thriving Urology Practice Facebook group, I have said, resist the temptation to buy that McMansion and continue to live like a resident after you get out of training. And then the overall long-term success that people have asked me, how did you get to where you are? I tell them two things. And I mentioned this at one of the young urologist forums that I was presenting at. Number one, don't buy stupid. And number two, marry the right person.
Yep. It's great advice. Man, we've covered so much here. This is great.
And I'm looking at the comments. You've silenced everybody. There are no comments. But I'm sure on the replay, there will be people who dissent, or some people will say, "Oh my gosh, this is such great information. Thank you so much for sharing this. This is truly amazing. Just a distillation of just the gold nuggets, if you will." Hard to find.
I mean, listen, thank you for inviting me. I love talking about this stuff.
Yeah. I think we all need a lot more information. Thank you again. All right, everyone, if you have any questions or comments, as usual, leave them below. And I'm going to reiterate what Dave said. Make sure you take care of yourself, and make sure you take care of your family, take care of each other. Be well, and I look forward to interacting with everyone. Bye-bye.